Welcome to this basic bookkeeping and accounting study guide, part 4 of 4 from TestMole.com, where employers can test candidates and teams using pre-built or custom assessments. We also create free tests and guides like this. Please help us by liking this video. Subscribe for more study guides and free tests. And turn on notifications. Okay, let's begin. Where is carriage outwards, delivery costs to customers recorded? In accounting, delivery costs are categorized based on whether they relate to bringing goods into the business or sending them out to customers. Carriage inwards, costs incurred to bring raw materials or inventory into the business. These are treated as a direct cost and included in the trading account as part of the cost of sales. Carriage outwards, costs incurred to deliver finished goods to customers. Because these are selling and distribution expenses rather than production costs, they are recorded as an operating expense in the profit and loss account. Let's review the options. A. Trading account, cost of sales. B. Profit and loss account, operating expenses. C. Balance sheet, current assets. D. Sales day book. The answer is B. Carriage outwards is an operating expense, not a production cost, which is why it appears in the profit and loss account. It is not a current asset, nor is it recorded in the sales day book, which only tracks the value of goods sold on credit. VAT is irrecoverable for a business if value-added tax, VAT, is a consumption tax placed on a product whenever value is added at each stage of the supply chain. VAT-registered businesses can reclaim the VAT they pay on business-related purchases, input tax, from the tax authorities, provided they charge VAT on their own sales, output tax. Non-registered businesses cannot reclaim VAT paid on their purchases because they are not part of the formal VAT collection system. Consequently, the VAT paid becomes an irrecoverable cost, effectively increasing the total expense of the purchase. Choose between A. The business is VAT registered. B. The business is not VAT registered. C. The goods are zero rated. D. The supplier is located in the UK. The answer is B. Because a non-registered business cannot charge or collect VAT, it has no mechanism to reclaim the tax paid on its own expenses, making that tax an irrecoverable cost. Registered businesses, zero-rated goods, and UK suppliers do not inherently prevent VAT recovery. The historic cost concept requires assets to be recorded at. The historic cost concept is a fundamental accounting principle that requires assets to be recorded at their original purchase price. This provides an objective, verifiable figure that is not subject to the fluctuations of market speculation or subjective estimates. While modern accounting standards, like IFRS, may allow for fair value adjustments for certain assets, the historic cost remains the baseline for initial recognition, ensuring that financial statements are based on actual transactions rather than hypothetical values. Choose between A. Current market value. B. The price originally paid for them. C. The replacement price. D. The liquidation value. The answer is B. Historic cost relies on the verifiable evidence of the original transaction price. Market value, replacement price, and liquidation value are subjective or future-oriented estimates that do not reflect the actual cost incurred at the time of acquisition. The owner introduces their own computer into the business. What is the entry? When an owner introduces personal assets into a business, the accounting records must reflect the increase in business assets and the corresponding increase in the owner's equity capital. Debit increases an asset account, equipment. Credit increases the owner's equity account, capital. This entry ensures the accounting equation remains balanced. Assets equals liabilities plus capital. Here are the options. A. Debit bank, credit capital. B. Debit equipment, credit capital. C. Debit capital, credit equipment. D. Debit purchases, credit equipment. The answer is B. The business gains an asset, equipment, so we debit that account. The owner's investment in the business increases, so we credit the capital account. Other options are incorrect because they involve cash or purchases, which do not apply to a non-cash asset introduction. A cash discount, settlement discount, is offered to. It is important to distinguish between the two main types of discounts in business. Trade discount, a reduction from the list price of goods, usually given to customers who buy in bulk or to trade customers. It is deducted before the invoice is even issued. Cash, settlement, discount, a reduction offered to a customer if they pay their invoice within a specific, short time frame, e.g., 2/10 net 30. Its primary purpose is to improve the business's cash flow by incentivizing faster payment. Choose between A. Encourage bulk buying. B. Encourage prompt payment of an invoice. C. Attract new customers. D. Reduce the list price. The answer is B. Cash discounts are specifically designed to speed up the collection of receivables. Bulk buying and list price reductions are the domain of trade discounts, while attracting new customers is a general marketing goal rather than a specific settlement incentive. Which of the following are subsidiary ledgers? Select all that apply. In accounting, the ledger system is divided to manage high volumes of data efficiently. Subsidiary ledgers, or personal ledgers, these contain the detailed accounts for individual customers and suppliers. They are used to keep the main ledger uncluttered. Nominal, general, ledger. This contains the main accounts for income, expenses, assets, and liabilities. It provides the data for the trial balance. Private ledger, used for sensitive information such as capital accounts, drawings, or directors' salaries, which are restricted from general access. The options are A. Sales ledger. B. Purchase ledger. C. Nominal ledger. D. Private ledger. The answer is A and B. Sales and purchase ledgers are subsidiary because they track individual trade receivables and payables. The nominal and private ledgers are main ledgers, not subsidiary ones. What is an error of principle? An error of principle occurs when a transaction is recorded in accordance with double entry rules, but the accounting treatment violates fundamental accounting standards. Specifically, this happens when a transaction is posted to the wrong type of account, such as treating a capital expenditure, buying machinery, as a revenue expenditure, repairs. Because the debit and credit sides still balance, these errors do not show up on a trial balance. Choose between A. Entering the wrong amount in both accounts. B. Entering a transaction in the wrong category of account, e.g. repairs versus machinery. C. Writing the debit on the credit side. D. Forgetting to post a journal entry. The answer is B. This is the definition of an error of principle because it involves misclassifying an item between capital and revenue. Other options describe different errors: wrong amounts, error of original entry, wrong side, error of commission, or missing entries, error of omission. Net assets is another term for. The accounting equation states that assets equals liabilities plus capital. By rearranging this formula, assets, liabilities equals capital, we arrive at the definition of net assets. Net assets represent the residual interest in the assets of the entity after deducting all its liabilities. This residual value is synonymous with the owner's equity or capital invested in the business. Choose between A. Current assets. B. Total assets. C. Capital, equity. D. Fixed assets. The answer is C. Net assets is mathematically equivalent to capital, equity, based on the accounting equation. Current, total, and fixed assets are components of the asset side of the equation, not the net value itself. When an asset is sold for cash, which account is debited? When a non-current asset is sold, the transaction is processed through a disposal account. The core double-entry steps are: debit bank, to record the cash inflow received from the sale. Credit disposal account, to remove the asset's book value from the books. This process ensures that the gain or loss on the disposal is correctly calculated by comparing the proceeds received against the net book value of the asset at the time of sale. Here are the options. A. Asset account. B. Bank account. C. Disposal account. D. Sales account. The answer is B. The bank account is debited because the business is receiving cash. The asset account is credited to remove the item, and the disposal account acts as the clearinghouse for the profit or loss calculation. Which of these is not a function of the general journal? The general journal, or simply the journal, is a book of prime entry used for transactions that do not fit into specialized books like the sales day book or cash book. Its primary uses include recording credit purchases of non-current assets, adjusting entries, accruals, prepayments, depreciation, correcting accounting errors, opening entries for a new business. Daily cash sales are recorded in the cash book, not the general journal. Possible answers are: A. To record the purchase of an asset on credit. B. To record daily cash sales. C. To record year-end adjustments like accruals. D. To correct errors found in the trial balance. The answer is B. Daily cash sales are recorded in the cash book, which is a specialized book of prime entry. The other options are standard uses for the general journal, which handles non-routine or adjusting transactions. If a customer pays in advance for services to be provided next year, how is this recorded at year-end? When a business receives payment before delivering goods or services, it has an obligation to the customer. Under the accruals concept, revenue cannot be recognized until it is earned. Therefore, the cash received is treated as deferred income or prepaid income. Item classification reason. Prepaid income current liability represents a future service obligation. Until the service is performed, the business owes the customer either the service or a refund, making it a liability rather than earned revenue. Let's review the options. A. As a current asset. B. As a current liability. C. As an operating expense. D. As revenue for the current year. The answer is B. It is a liability because the business owes a service to the customer. It is not revenue because the work hasn't been performed, and it is not an asset or expense because it represents an obligation, not a resource or a cost of doing business. Which of the following accounts normally has a credit balance? In accounting, the DED-CLC acronym helps identify normal balances. Debits, expenses, assets, drawings. Credits, liabilities, income, revenue, capital. Sales is a form of income. Since income increases equity, it carries a normal credit balance. Conversely, assets like inventory and motor vehicles and expenses like rent carry normal debit balances. Here are the options. A. Sales. B. Inventory. C. Rent. D. Motor vehicles. The answer is A. Sales is an income account, which follows the credit side of the accounting equation. Inventory, rent, and motor vehicles are assets or expenses, which are always recorded as debits. The three columns in a three-column cash book represent. A three-column cash book is a specialized journal used to record all cash and bank transactions in one place. The three columns are designed to track the movement of liquid assets and the impact of early payment incentives. Cash column records physical cash receipts and payments. Bank column records deposits and withdrawals via the bank. Discount column records discount allowed on the debit side or discount received on the credit side to reconcile customer and supplier accounts. The options are A. Cash, bank, and sales. B. Cash, bank, and discount. C. Cash, bank, and capital. D. Cash, VAT, and net. The answer is B. The three columns are specifically for cash, bank, and discount. Other options like capital, sales, or VAT are general ledger accounts, not the primary columns found in this specific book. What is the purpose of creating a provision for doubtful debts? The prudence concept dictates that a business should not overstate its assets or profits. If a company has credit customers, there is a statistical likelihood that some will never pay. Creating a provision for doubtful debts allows the business to reduce the net value of trade receivables on the balance sheet, recognize an estimated expense in the income statement. This ensures that the financial statements reflect a realistic view of the amount the business expects to actually collect. Possible answers are A. To ensure the bank manager is happy. B. To estimate and record expected losses from credit customers in line with prudence. C. To increase the value of trade receivables. D. To pay for bad debts when they occur. The answer is B. This provision aligns with the prudence concept by anticipating potential losses rather than waiting for them to happen. It is an estimate, not a payment method or a way to inflate asset values. The matching concept accruals ensures that the matching concept or accruals concept is fundamental to accrual accounting. It dictates that the financial performance of a period should reflect all revenues earned and all expenses incurred to generate those revenues, regardless of when the cash actually changes hands. Goal: to provide a meaningful measure of profit for a specific period. Application: if you sell a product in December, the cost of that product, COGS, must be recorded in December, even if you pay your supplier in January. Let's review the options. A. Expenses match the cash paid in the period. B. Expenses are recognized in the same period as the revenue they help generate. C. Debits always match credits. D. Opening inventory matches closing inventory. The answer is B. Matching ensures profit is calculated accurately by linking costs to the revenue they helped create. It ignores cash timing, which is the focus of cash basis accounting, not the accrual-based matching principle. Thanks for watching. With TestMole.com, you get everything in one place, from easy candidate invites and role-based access, to deep analytics and built-in anti-cheat mechanics. We'll assess code answers, free text responses, and issue verified certificates. Ready to simplify your hiring? Give TestMole a try. And one more thing. If you like this video and want to see more, don't forget to like and subscribe.